All right. Good afternoon, evening, morning, depending on where you are. It is good to be back with you for day two for covered calls. And I just want to welcome everybody in. And we're going to have a good, exciting time here the next hour and a half. I just want to cover a couple of administrative type activities before we get started. And just know that, hey, there's a whole lot of you, and there's only three of us, really. There's me, there's Scott, and we got Scott Thompson on the chat, and he will do the best he can to keep up in the questions that come across. We'll try to dwell things in as we go along, but just know it goes by pretty quick. And if we miss you, I apologize. All right, a couple of things. Let's see. We started with basic options and Greeks yesterday. We'll do a little small recap before we get into our cover calls because I want to kind of tie some things together as we get into cover calls because they do relate, and we're going to do that. Also know that um, there's many ways to help get caught up on things you might miss, or if you want to get caught up because it went maybe too fast or you missed something. And we'll show you how that works as we go along in the class itself. Okay. I do want to introduce my great friend, the Scott Durfey, here in a minute, and we'll get started. But before we get all that going on, I do want to, here we go. We do got to cover a few administrative things with regard to what's called disclosures. All right. And just know that as we get started, that options do carry a level of risk. And because of that, options may not be suitable for all investors. And we'll discuss some of those risks as we move along, of course. Um, do know that with long options, investors may lose 100% of the funds invested. That's how it works. And then when we get into spreads later on, we're not doing them today, but must be traded in a margin account. Know that also you have a paper money account out there that you can get onto through Think or Swim. And just know that paper money account is just that. It's fake money. I mean, you can make $1 million in there and you can call up and say, hey, move my money over, and they're going to laugh. Okay. But it's a great way to practice new strategies like a call or a put or a covered call or a vertical spread or selling puts, the things we're doing this week. And so with that, use that paper money account. It's a nice thing to do. And just know that when Scott and me or Scott Thompson bring up a ticker symbol or we talk about something live as we're doing examples, they are examples. They're not a recommendation. It's not an endorsement. It's not a wink, wink, hid, none of those kind of things. It's just for educational purposes only, and that's how it works. All right. I think we've covered everything on that side of the business. I do want to introduce my partner in crime, so to speak. All right. We've been doing this together for many, many, many years, both live, out on a stage and virtual workshops over the last several years. And that man is Scott Durfey. You see him right there, regular contributor to the Schwab Network, which is brought to us by a separate but affiliated company known as Charles Schwab Media Productions Company. And he specializes in teaching the platform. All right. I mean, this is not a platform class. Unfortunately, but sometimes that's needed, and we'll show you how to get that help as well. But technical analysis, stocks, option strategies, as we saw yesterday. So great to have him here. And with that, Scott Durfee, say hey.
Hey, 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 everybody, welcome back. What a day in the market, huh?
Yeah.
What a day in the market. I'm seeing a lot of that comment in there. And Ray, and I'm glad that you drew attention to something that I want to also draw attention to before I turn you loose with these guys. But that is that yesterday, some of that felt a little bit fast for some people. There were a lot of people who actually have acknowledged that they weren't actually able to attend yesterday's class as well. So the link to Scott Thompson, and I'm a big fan of Scott Thompson, great guy here. He would be fun to even have help teach this class, Ray. But Scott Thompson is manning our chat, so to speak, and he will drop in a link that is I think there's 93 videos involved in this. It's a getting started with options class, and some of my favorite instructors are there. What we're doing here is really meant to supplement the deep dives that you'll do in those types of things. And so Scott's dropping that in there right now as well. Ray's going to go through a little bit of a review, and Ray and I will go through a little bit of review in today's today's class before we get things rocking and rolling. But I just want to acknowledge Ray. We're going to let Ray take over most of the class this evening. He'll be driving as we talk about what some people consider, some traders consider, the gateway drug to options trading. And again, a fun trade for sure. A lot of traders and investors see it that way. I say all of that in jest, but there may be just a little bit of truth to it as well. My good friend, Mr. Ray Kimbrell, as you can see there, he's been an education coach since 2004. He's a regular contributor also on the Schwab Network. He is also specializes in teaching the Thinkorswim platform, technical analysis, option strategies, etc. The Schwab Network, of course, is brought to you by our Charles Schwab Media Productions Company. And so there you go. Ray, I'm going to go ahead and kick it, kind of volley the ball back to you at this point. I'm standing in the wings here, anxious and ready to come in and contribute where I can.
Sounds like a plan. I'll definitely be pulling you in, so just hang by. So,
Okay.
folks, there you see right there. That's the what we've been doing so far. We got options, basics, Greeks, cover calls today, cash secure puts tomorrow. Scott will drive that discussion, and then he and I will do short vertical spreads together with you guys on Thursday in that Q&A session. And we'll drop in the directions to put questions into the portal, so to speak, so you can, if you need to put some questions in over what we've talked about this week, you can. All right, so a couple of things y'all already did is teach me options from the ground up, explain the Greek simply and practically. Did that yesterday. I'm going to tie it back in today and all week, matter of fact. Show me how to choose the contract. We're going to do that here in just a second with some covered calls and then do an example call trade here. Place and manage trades and help me avoid losing money, risk management, mistakes, those kind of things. So that's what's on the docket this whole week. And we are going to enjoy bringing that to you. So let's get moving here and see what we got going. So covered calls. Well, before we get into covered calls, let's do this real quick. Let me go live to the Thinkorswim platform. Okay. And let's see, how did the market do? What did the market do today? It was up, it was down, and it finished back up again. How about that? So there you go. S&P, not as much. NASDAQ still down 329. All right, but let's do this. We talked about stock yesterday, stocks and potentially wanting to buy a call. So if we want to buy shares of a stock, you can do that, right? You can put that money out there, full price of the shares, whatever they are. Like this one right here, this is called DXCM as an example. If you go to the chart real quick, all right, and I want to show you just an example of look at a chart and say, let's buy a call. Because if you were going to buy this stock, all right, if we are going to buy this stock right now, all right, now, oh, hey, Scott Durfey, look at this. It's at an all-time high, 78.82. So does that mean it can't go any higher?
Absolutely not.
Okay. And so some people look at this and they go, "Oh my gosh." All right, but we got a stock that kind of formed a little bit of a hammer, then it kind of consolidated a little bit. Now it broke out and it's got a hold right now, which means it's a close above the high of the low day. I'm not going to get into technical analysis with you right now, but here's the MACD. It's turning back up. Our RSI is turning back up. So we got a 10-day moving average. This blue line, it's uptrending. Our intermediate is going up, our moving average, and our long term is kind of going sideways. So kind of a bullish type of a situation on this stock. What do you think, Scott? A little bullish, you might think?
Bullish indeed.
All right, so some investors may say, I'm going to buy this stock. So if you're going to buy this stock, okay, if we're going to buy this right here, we could do a couple of ways. We can just do it right off of the page. You can right click and you can click buy. All right. And it's going to pull up an order. It's going to say buy 100 if you want to do 100, okay, of DXM at 78.03, which was currently trading. Okay. And that's going to cost you a little bit of money. All right. It's going to cost you $7,803. Now, some people may say, I don't put that much money into the market or tie those many assets up, but I do like this stock. I want to be able to control the stock. And as Scott taught you yesterday, that's like it's a coupon. It's an option contract. Gives you the right to do something if you go long a call in this case. Because remember, Scott, where's your phone? Come on, I know you got the phone in your office. I know you do.
Yeah, I got it. Actually, I don't. It's out in my barn.
Oh my goodness. All
Yeah,
right.
it's out where it belongs.
So we played a good trick on Scott one day for his birthday in a workshop, and my daughter helped me, and he always uses this great analogy: call up, put down, call up, put down. And so if we think the stock's going to continue in an upward trend, and we think it's going to do this for a little while, we may want to use a call option to and go long the call option, buy the call option, buy this coupon. All right, this gives you the right to buy the stock at a selected price, the strike price, on or before the expiration date. Okay, call option. Did all that yesterday. All right, just got a reminder. All right, so and this gives us the opportunity instead of spending $7,803. Okay, so let's delete this trade. Don't want to do that. But we can see the positive, the bullish side to that. Does everybody follow me so far? If you are, just put a thumbs up in that chat and understand. Okay, yes, it makes sense. A call option makes money when the stock goes up, but it has to go up. Now, here's the other thing, Scott. Does the trader have to own these shares in order to buy a call? What do you think?
No, they in order to buy a call, and that's one of the things about buying a call, Ray, that a lot of traders see as being an advantage is because actually when we're buying a call or a call contract, we're really not necessarily trading, even though all things are tied to that call contract, we're not necessarily trading the underlying shares. We're trading the value of the contract.
Right. Because the contract's getting its value from the underlying, correct?
100% accurate. That's what we call a derivative. We remember we talked about that last night. A contract of a stock and that's a true for a call or a put. But the value of the contract of that stock is derived from the value or the price action, among other things. You talked about those when you talked about the Greeks, among other things, um, tied directly to that underlying stock or ETF.
All right. So most people are following along. There's a few folks that are not yet, or they're understanding. No, you don't have to. Okay. They don't understand that houses make money. We're going to show you right now.
Yeah,
So you remember the Greeks. We talked about the Greeks, and they're up here, Delta, Gamma, Theta, Vega. Okay, right across the top up here. And I opened up the 38 days till expiration. Remember, it was 39 yesterday. It's 38 now, right? Because we got one day gone. And here are some figures in there, okay? And I got 8 strikes opened up. So here's the prices at which we can control the stock. All right, right through here, the strike prices. If you can see the underlying price, the last price it traded was 78.19. 78.19. So we have these in purple, which are called in the money. These in the black are known as out of the money. In this one right here, I would say the $80 strike is the closest to the stock price. All right, so that's the at the money. Okay, that's at the money. And even though, and the reason why it's black is because it's an $80 strike, it's 78 here, so there is no intrinsic value. All right, it's all extrinsic at that level. The ones that are in the money have intrinsic value. And if you remember, the intrinsic value means what? It is the value, the option value is the the stock price minus the strike price. Okay? And that's how you get your value. Now, let's figure this out. Let's get going. All right, if we wanted to buy this, if we wanted to buy this stock, if you go further in the money, the deltas are going to give you they're more sensitive to the price movement of the stock. The further you go out of the money, they're less sensitive because like this one only moves 17 cents or gains 17 cents in value for every dollar move. This one gains 81 cents for every dollar move. Okay, that's what we mean by more sensitive or less sensitive. So let's say we wanted to buy this call option, okay, as an example, and we're going to go out so it expire in 38 days. So if I go to the chart tab, if I think it's going to move up in value over the next 30 days out to here, okay, that gives me a lot of time to let this stock move up. And that's what I'm looking at, okay? That's what I'm looking at. So if I go back to my trade tab and I opened up this section of the call options, okay, or put options, but in this case, calls because we're going to think it's going to go up. All right. And I want to buy this, I can do it one or two ways. All right. Because I have this set on a single, which means it's going to buy a call, is all it's going to do, because you can change this to different types of strategies if you want. Okay. We have it on single right now. So if I just click buy on the 70 strike, all right, I'm going to pull up an order automatically. It's going to pull it up and it's going to say buy. In this case, defaults to one contract. All right, this is the expiration date, which means I have to do something on or before that date. Okay, and it's going to cost me $10.50 per share. I'm doing one contract, so that's going to be how many shares? 100 shares. Okay. That means it's going to cost me what? A little over $1,000, right? So if I do confirm and send, all right, it tells me I'm going to buy DXCM 100, all right, the $70 call, 1050 limit to open. That means I'm opening the trade. I'm starting the trade. I'm going to be long the stock here. My break even price is 80.50. Why is it that? Because what? I'm spending money on this. It has to move somewhere. It has to go up to 80.50. All right. Start breaking even. It's going to cost me $1,050. And there's no fees when it comes to trading options except for the contract fee, which is 65 cents a contract. All right. So there you go. That gives you the explanation. What is it you want to buy? How you want to do this? And so that's what Scott was showing you yesterday. So it gives you the right to buy those shares at $70 on or before the expiration. All right. So if I like that, I'm going to go ahead and hit send. All right. Now I got the orders placed off in there. All right. So now all I got to do is watch this and hopefully it's going to keep going up. That's the idea. Now, how does that work? How does it make money? That's what someone asked earlier. Okay. So let's look at this. I showed you the Greeks yesterday. Let me show you a little tool where you can look at this and see how that's going to work. So if I go up here on this bar, all right, right above where it says options chain, where you see delta, gamma, theta, vega, right? I open that up and I go to Theo price mark and I click that. All right, it's the bar right next to single. You just open it up and click Theo price mark. Okay. Now, when I do that, okay. Oh, yes. And these are American style options, not European style. And by the way, I'm going to show you when I get done with this, what Scott was talking about with regard to the um, getting started with options courses. And the other nice news is all these things we're doing this week are recorded as well. Okay. So now I got Theo price mark opened up. Now I'm going to open up the bar next to it. Okay. When I open that up, it's going to give me some opportunities here to show you how the Greeks actually work when it comes to buying or selling an option. All right. It's going to show you how the premium changes based on the three main factors that Scott talked about yesterday. All right. Which is price, time, and volatility. All right. Three main things: price, time, and volatility. Okay. Now I gotta see, where did you select the type of order? All right. All I did was when I clicked on the like, let's close this down. When you click on the strike price, you right click on it, it gives you the ability to buy and then the type of trade that you want to make. Okay. Buy, then type of trade you want to make. All right. It's a good question. So here we go. We're going to open up our Theo price mark bar. And what I'm going to do is I want you to watch this figure right here. All right. You see where it says 970? All right, let me circle it real quick for you so you can see it. All right. If I go, okay, it's good. If I go right here, this is the number I want you to watch is this number right here. Okay. It's under the Theo price section. I want you to watch that number as I change the parameters in our Theo price mark section. Okay. So let me, I think I have to clear it off because if I don't, it won't be, let me advance. All right. So here we go. If I just go out in time, do you remember yesterday? What is something that takes away value every single day? What Greek takes value away of a long option every single day? That was theta. Remember? Every day. See? And so when you hit this time right here and you don't change price, you don't change volatility, I want you to watch what happens to the 970. All right. I'm going to write that down, matter of fact, so I don't forget what it is. All right, 970 is our base right now. And if I go in here and I change this calendar out, so right now we're on the 9th. Let's say we go out, and this is 38 days out. So let's say we go out 2 weeks to the 23rd. All right, go out 2 weeks to the 23rd. Okay. And I see we got some cover calls. Questions. Hold that thought. We're going to do cover calls here in just a second. But I want to do it to review because this helps you understand Greeks, helps you understand option pricing. All right, so here we go. We're going to do the 23rd. We changed that to the 23rd. Okay. And just by doing that, just by taking away 2 weeks of time, remember, theta does what to long options? Decreases their value. Do you notice what the theoretical value of the option is now by just time changing and nothing else? It went from 970 to 905. 970 to 905. And that's why we showed you yesterday when you go closer to expiration, remember that curve steepens as you get closer to expiration. It means that means theta is increasing more rapidly. So you lose value more rapidly. Okay. So I hope that makes sense to you now a little bit. All right. So let's do this. Let's go back, hit reset. We're back to normal at 970. So now we're going to do two things. Now we're going to say, okay, the price of the stock goes up. And let's say it goes up $10. All right. Goes up $10. All right. Stock price adjustment. And I'm going to hit enter. Now watch what happens when I hit enter. All right. To this number right here, the 970. Okay. I'm going to hit enter. All right. Now look what our value of our option is 1869. So we went from 970 to 1869. So those of you who are going, how does an option make money? I don't understand this. Well, the stock went up in price. You bought a call. The premium goes up in price because of the deltas, right? All right. Now then, watch this. Let's go back now to our time, though. Now watch 1869. Now let's go back out that 2 weeks, 23rd. All right. We're going to lose some value now, right? Because what happens? Theta kicks in, and now we're at 1843. All right. Do you see how that works? So it's not just one Greek, it's all the Greeks working together. It's all the Greeks working together. Now, let's see what happens. So, volatility. Now, a lot of times when a stock price goes up, volatility goes down, doesn't it? So, let's do this. What if we do a minus and we do 10%? All right. We adjust for volatility. Okay. Because let's say volatility went down. All right. The price went up. We lost some time value. Let's hit enter. Now, 1843, let's see what happens. Oh, 1838, because we're further out in time right now. So it's not that big of a hit. But if you go up here and you change the date now, let's say now we go up one more week. Let's see what happens to the 1838. Oh, 1832. Okay. Let's go out to next month. Let's go out to July. We're getting closer to expiration. Let's go to the 7th. Oh, 1827. Okay. So you see what's happening to the value because of time value. All right. That theta kicks in. Let's get closer to expiration. Let's go to the 16th. Oh, all right. And let's see what's going on there. Now we're down to 1821. So you got to be careful when you come in and seeing what happens to your price. If it didn't go up $10, if it only went up, let's say $5, okay, you can change, you can move things around as much as you need to. All right, hit enter. And it's at 1321. If it fell down, it was what, up 10 and went down $5, you're still up, but you got a little more of a haircut because of your deltas and your price action. So as Scott was teaching us earlier, price, time, volatility. So quick exercise on the Theo price mark. Here's the thing. Remember, always hit reset when you get done. Go back to your normal prices so you don't get confused on your platform. Okay. Now, why is 17th July blacked out? That was expiration. Okay, that's the expiration. See, 17 July. That was the expiration on the option. All right. I hope that helped a little bit. Scott Durfey, anything you want to add there with the Theo price mark example there?
No, just that I think that that's a great tool. When I was learning this stuff, very helpful in understanding. One of the most difficult things for me to begin to understand when I started this was just the concept of trading contracts. And that right there helped distill it down to the
Yeah.
contract concept and made it much more simple for me. So
There
thanks
you
for
go.
that valuable information, Raymond.
You got it, my friend. And hope that helped everybody else a little bit. I see some questions. I'm going to answer some of these questions on the covered calls as we go through. Um, and just know that there's volatility increase as we approach the expiration date. Actually, volatility numbers get a little bit lower as we get close. So if we go back and change this to delta, gamma, theta, vega, you see we're 30 days out. If we open up the 18 Junes, look at our vega numbers here. They're a little bit lower as you get closer to expiration. Okay. But what gets more, look at theta. Look at how much theta has increased there. Okay. And it's a percentage on the volatility for every uh, percent volatility moves. Okay. And that's why you see volatility on the charts and also at the end of the option chain is measured in percentages. All right. Let's get going to cover calls. Here we go. All right. So, first thing I want to do is this: what it is selling options to generate income through premium. Okay. We're going to collect premium when we sell the option. Okay. The example we just did, we bought, so that was a debit to our account. But now we're going to go through and we're going to collect money. All right. We're going to sell an option, in this case, a call option. We're not going to do any puts today at all. All right. This is all on the call side. And we're going to sell a call option to generate income. All right. There was a question earlier. How do I manage this within my portfolio of bringing in some money? Okay. And do this. So we're going to explain that as we go. So collect premium. That's the pro. The con, all right, is you have the assignment risk. Now, Scott, what is this assignment thing? What is this assignment risk? What is that?
So anytime, Ray, anytime that you're in a short option, one second, I'm going to call. Anytime that you're in a short option, like we will be in this, we run the potentiality of receiving a assignment early, and it's not really early. I mean, it seems early, but according
Anytime, actually, right?
yeah, and that's the whole deal. It seems early, but according to the contract that we're in, it's not early. It just can happen anytime. It's not just subject to expiration. So we need to know that. We need to know that we can, in this case, have the stock called away at any time. There will be reasons that potentially other investors and traders will want to take our stock, and we can get into those kinds of things as we go through this
Yeah.
strategy.
Cool. All right. So the goals here is search for, we're going to evaluate actually securities that meet certain criteria, our sample criteria. We're going to calculate position size and plans and exits. And we're going to practice doing some covered calls. And there's kind of three big ways we're going to do covered calls. We're going to do a covered call where we don't own the shares at all. We got to buy the shares and do the covered call at the same time. And then we're going to look at potentially how, if you already own shares of stock, at least 100 shares, right? Because you got to have 100 shares because one contract is what? 100 shares. All right. And we're going to leg into a covered call. And then we're going to look at a covered call possibly where, hey, maybe I want to be taken out. I want to be taken away. So, Scott, I know when we teach this in the past, we always said, you should always ask yourself, when I do a covered call, am I okay with losing these shares? Right?
Yeah, and I don't like the word losing. Because losing kind of implicates me in a bad decision or something like that, and it's just a psychological thing for me. Because if I'm entering into a covered call situation, I by all means need to not only be prepared, be fully expecting that those shares be called away. So I need to take into consideration all all considerations
Yep.
associated to that before actually enter into that trade.
Yep. So Dry and High ask, are assignments bad for you? Well, if you didn't want to lose the shares, all right, or get them taken away from you, then that
Yeah,
might be bad for you. All
it
right.
might be. Yeah.
But the here's we're going to cover that, and that's a good question because a couple of things that you're going to see here is how that kind of works. All right, and donate my shares. There you go. Okay, so here's the objective of the covered call: to generate income by selling an out of the money. All right, OTM means out of the money. All right, by selling out of the money calls on stocks you already own. Okay, that's the legging in thing I was telling you about. You already own these shares. So maybe you want to sell a call. And you remember now, this is why we showed you that example first thing here, and then Scott did them yesterday. I want you to remember this terminology. I want you to understand, remember what out of the money means. Okay. What out of the money means is what doesn't have any what? Intrinsic value. All it has is what? Extrinsic value. All right. Volatility, time. All right. All those things. Okay. No intrinsic value. All right. So we're going to sell out of the money calls on stocks you already own. All right. Consider when conditions are favorable rather than on regular schedule. There's a practice sometimes people think, you just every month do the covered call. You own shares every month, do the covered call and generate income off of it. Because when we say generate income, is because you pull in the premium when you sell the call, right? And you can, because you own the shares, and we're getting this in a second, because you own the shares, if you are assigned and you have to give up your shares, as Scott says, lose them, they're out of your account, you already have them. So you're okay. You don't have to go out there, buy the shares, and then give them up. So, for example, if you were not covered by owning the shares first and you just sold a call option naked, all right, that's what it's called a naked call. You don't own the shares. That's called unlimited risk, all right, because you don't know where the stock can go. So, if you sold a $50 call and the stock goes up, all right, and the market says, hey, you have an obligation to provide those shares, all right, I want the shares. And you say, ha, too bad. I don't have the shares. And the market's going to say, ha, too bad. Go get the shares and give them to me at that strike price that you sold them at. So let's say you sold a $50 call, you don't have the shares, and the stock went to 75. You're going to have to go out there, buy the stock, buy the shares at 50 and at 75 and give it to them at 50 because that's where the price of the stock is if you didn't have them. All right, you have to provide the shares at 50 because you sold the $50 call. Does that make sense? Okay. All right. Yes, ouch is correct. All right. So here we go. So in these situations, we talk about everything we're going to discuss right now. Now, before, when we did that example trade, first thing, remember, Scott, he explained to us, we do not have to own the shares to buy a call. Okay. In this case, you have to own the shares. Okay. You have to own the shares and you have to own at least 100 shares to sell one contract because each contract controls 100 shares. Okay. All right, Andrew, hold tough. You'll come to you. Just keep watching. Keep an open mind. Here we go. All right. So it says stock, long stock, bias is bullish. Okay. The option, the short call. All right. Really, that's a neutral to bearish type of a trade on the selling of an option because when you sell options, sell call options, you want the stock to go down. Okay. But you own shares. So by rule, has more positive deltas. So this is really a bullish trade because of the stock position you own. Okay. Let's keep moving. So, I went the wrong way. Sorry. All right. Managing money management when it comes to this. All right. Consider selling up to one call contract for every what, folks? 100 shares of stock. All right. In your position. So, number of shares you own. If you divide it by 100, okay, that's the max number of contracts you can sell. So, Scott, let's say you own 100 shares of Apple. Or, I'm sorry, 500 shares of Apple in your account. All right, and you want to do a covered call. Do you have to do 5 contracts?
No, you do not. But you have to do at least one. You can't do a partial contract.
Right. There's no 1.5 and those kind of things on
Correct.
anything.
That's
Right.
correct. Yeah.
So it's all whole numbers.
Whole
All right.
numbers.
So if you have, and we'll do an example of this a little bit. I got an example of where I own in my training account 500 shares of a stock, and we'll do a leg in on that. Okay. So you can do, could you do 5 if you wanted to, Scott? Could you do all 5?
Yeah. Well, certainly. Yeah,
Yeah.
you certainly could. Yeah.
And what could happen though?
Well, you could lose all 500.
Oh, you said we'll lose. Ha ha ha.
Yeah.
Just checking.
See, I hate that word. But Thanks for
All right,
calling me on that.
here we go. Let's keep going. Risk profile. So what this shows you here, folks, is this. All right. A max gain. All right. Premium plus the gains in the underlying up to the strike price. What does that mean? So if you sold, all right, let's say you bought shares at 40. Okay, you bought shares at 40 and you sold a $50 call. All right, so your covered call is 50. Okay. In that case, and you bought the shares at 40 and the stock goes to $51. Okay, and it's at expiration. And so now your option is what's known as in the money. All right, it has intrinsic value. Now, as a covered call trader, and you if you did not want to lose your shares or give your shares up, this is not good for you. But let's say, too bad, so sad, you're okay with it. All right. It goes to $51. The market's going to say, okay, give me the shares at 50. Okay. So what happens then is you get to keep the premium when you sold the call, and also you get to keep the value from where you bought the stock at 40. Okay. And then you had to sell it at what? 50 or 51 in this example? 50. Because what did you do? You said you'd sell it at 50. You sold the $50 call. So you get
Mhm.
to keep that $10 difference in the difference of the stock price, and you get to keep the premium that you did when you sold the call. So now how many people are going, ooh, man, that's not that bad of a situation. That's not too bad. Okay. So that's how that works. And that's what this is showing you. So this line across the top, that's your cap. So if even the stock went to 55, doesn't matter. You sold the 50, you have to give it up at 50. Okay. Have to give it up at 50. Now, the downside of this is right here. If the stock goes down in value, okay, because remember you own shares, okay? So if this is the case, all right, then you're going to have to say, okay, if this keeps going down and down and down and down, what do I want to do? And this is that exit strategy discussion we talked about. You may want to say, oh man, I need to get out of this trade. Okay, I need to get out of here. So if that's the case, if you have a call, a short call on your stock you own, you have a covered call going, you got to unwind this. And we're going to get into that. And I see there's a question about rolling already. We'll get there too. All right. So if that's the case, and we're going to come back to this again, but I'm going to give it to you now. To get out of the trade, you have to buy back the call and then sell the short, um, the short, the stock. Okay. You have to buy back the call and then you got to sell that stock if you want to get out of it totally. Because here's the thing. It's right, buy to close because you sold to open. All right. So in this case, the reason why you do it in that order is you don't want to have your call out there by itself and have a naked call in place. All right. And if you're not even, and you have to be approved, by the way, to do naked calls. So if you're not approved for it, why don't you do it anyway? But let's say you are, you may not want to be having a naked call in your account. So you have to do it in reverse order. So when you do a covered call, you're going to buy the shares, sell the call. To get out of it early, you're going to buy back to close the option and then sell the stock. Okay. All right. We're going to get into that in more detail, but I wanted to give you a precursor of what's coming. Okay. Here we go. Example. Here's an example. Now, yes, we do know our alphabet. Okay. And the reason why it says ZYX is because guess what? There's now an XYZ stock. We used to be able to do an XYZ example. Can't do it no more because there is actually an XYZ stock out there. All right. So let's say you own 100 shares of this ZYX stock. All right. And it's at $46 per share. All right. $46 per share. You see it right there. Okay. Now, you decide that you would like to um, get some premium off this, generate some income. Okay. And you decide that you want to sell a call contract. Okay. And when you do this, you sell the $48 strike. All right. And it expires in 30 days. All right. And you get a credit of $1. So that's what this strike means up here. All right. You sold a call. All right. And when you sold the call, all right, you pulled in $1 of credit, $1 of premium. So the ask price in your options chain had $1 in it. Okay. And that's where that came from. All right. So you sold the 48 strike. All right. And so right now, if you're in this situation, what would be your ultimate goal? You would like this stock to stay where? All right. Scott Durfey, would you like to see it stay below that 48?
Yeah, below the 48
All
in,
right.
in theory. Now remember, and I'm going to throw this back at you. There is a strategy in place here wherein people are willing to give up their stock at that
Yeah,
price.
but we're just doing the basic now. So in basic general covered
Yep,
call
yep,
terms,
yeah, below that $48. Yeah,
right. So so in other words, you want the option to expire what's known as out of the money, correct?
that's correct.
Out of
Yeah.
the money. So it has no value, correct?
Anything above 48 would be in the money.
All
So
right.
anything at below 48 out of the money.
There you
Read,
go. All
read.
right. So option. All right. Call the strike price 48, premium $1. All right. Y'all with me so far? It looks like you're with me. You all are following so far. All right. Below, keep the shares. You guys are answering correctly. Good job. All right. Now here we go. Now, what if the stock goes up a lot? Okay. In this case, a whole extra dollar. All right. All right. So I guess a relative term. All right. So let's say the stock goes and rises to $49 prior to or at expiration. Prior to or expiration. There you go. 49 bucks. All right, what's going to happen? Oh my. Oh no. You got that. And by the way, if you've been trading a little while, I don't think you're swim. Have you noticed that in your monitor tab, a lot of times you'll see the little letters ITM on some of your trades. And you're like, oh gosh. All right. Because now you're in the money. Yeeks is correct. All right. So here we go. So you're in the money. All right. And that necessarily doesn't mean a bad thing because sometimes you can be in the money and you don't get assigned right away. You wait till expiration. Matter of fact, Scott Durfee, have you ever been assigned early?
Yeah, as a matter of fact, I have.
Me too. All right. But does it happen a lot?
Well, no, I mean it doesn't. It feels like it happens. If it happens once, it feels like it happens a lot if you're not prepared for it. But no, it does not happen a
Yeah.
lot.
And
Yeah.
there's even some folks on the here talking about, their stock went up 40 points and they probably didn't get taken out right away, okay? Or may not taken it out at all until expiration. So I'm not
Yeah, but
telling you
don't
it's
plan
always
on
going to
that.
happen.
Don't plan on that.
There
If
you go. I'm not telling you it's always going to
goes,
happen, but
if it goes
it can
in the
happen.
money, plan
That's
on it.
right. You can be assigned at any time, whether you're in the money or out of the money. It can happen. All right.
Right.
So just
That's
be
right.
aware of that. All
Yeah.
right. There's a few that said never been assigned early. That's fine too, but it happens. Okay.
Yeah.
And yes, this will be recorded. All right. So just know that going into this whole situation. All right. Now, if it's in the money, there's some things you can do here. All right. You're likely going to be assigned to sell your shares at what? 49 or 48? You got to sell it at 48 because what did you sell? What is your obligation? You sold the $48 call, right? You sold the $48 call. All right, so that's how you're capped, all right? 48. So it can go to 49, it can go to 50, it can go to 55, it can go to 60, and you still have to sell it at 48. Okay, very good. All right. So what is the criteria for being assigned? The criteria is you sold the option. That's your criteria. They can assign for any reason they want. They need the shares to fill an order someplace else. They, the market makers. It
Hey,
doesn't matter.
let me give you one example of that. For example, if I want to obtain a stock, get a stock, buy a stock that has a dividend coming up, and dividend risk is something that can be tied to these types of things.
Yep.
I may want that stock, and for that reason, I may exercise a long call at your short position in order for me to take possession of those stocks. They will liquidate yours at that same strike price to liquidate yours to fulfill my position so that I then can obtain the dividend, for example. So there's a lot of reasons that this stuff, that's only one, but there's a lot
Yeah.
of reasons that this can happen.
Yeah. So Lon Shenanigan says, I wanted to get assigned and it expired out of the money. Well, the good news for that one is you expired out of the money, so you get to keep all the premium. You still have the stock. All you got to do is what? Sell the stock.
Yeah.
Okay. So there you go. All right, here we go. So in this case, you get assigned. All right. Profit on the stocks are capped at the strike price. So you get to keep the you get the whatever you bought it at, you got to sell it at 48 and you keep all the premium. All right. So short call premium, $1 per contract. Stock is at went up to $2 because you bought it at 46 and went up to $2. You got to sell it at 48. So you made 300 bucks. Yay. Okay. Yay. Very good. All right. That's one example. Here we go. Now, what happens? All right, what if the stock goes up a little? So you bought it at 46. Remember the example, bought it at 46. Let's say the stock only rises to $47 prior to or at expiration. Prior to or at expiration. All right, you sold the 48 call. All right. Your option is now what? Out of the money. All right, your option is out of the money because it is the value of the stock is below the $48 call that you sold. All right. So it's out of the money, which means it has no intrinsic value, only extrinsic. All right. Which is time, for example. All right. Will it likely expire worthless? There's the good question. All right. Will it? All right. So this is when you got to start watching. This is why we talked about theta earlier. And you may not just want to hold on to the whole time because as you get closer to expiration, things start happening quickly. All right. Things can go against you quickly. And then you may be in the money when it was out of the money just a short time ago. So you'll hear this as we get closer to the end of the class today. But as you want to get out of your trades, maybe you want to look 4 to 10 days prior to expiration to close these trades out. All right. And the main reason is to get rid of the obligation. Okay. Because if you don't have the obligation to give up your shares, you're in good shape. Okay. So you got to say, so you're going to ask yourself, will it likely expire worthless? Is it going to stay out of the money? Okay. So let's say it does. If it does stay out of the money, all right, you keep your premium, the $1 you pulled in, remember earlier. Okay. And the stock went up $1. So you got an increase in the stock. Okay. And then, so now you're up $200, correct? Okay. And you got out of the trade. You made 200 bucks. Now, please don't ask about tax. I'm going to bring it up, but I will because someone's going to bring it up eventually. All right. Consult a tax advisor. Scott and myself are not tax advisors. We can't get into all those discussions. All right. But if you're in a non-taxable account, for example, let's say you're doing this inside of an IRA, is it going to matter? No, not until when you pull taxes. Okay. There's someone already. I was reading your mind, Echo Barry. I was reading it, man. I knew it was coming. All right. All right. So just be ready for that. Okay. All right. All right. Here we go. So what if the stock goes down a lot? All right. What if it goes down a lot? All right. In this case, 44. All right. Stock falls to 44 bucks. You bought it at 46. Okay. At or expiration. So your option is obviously what? Out of the money. Okay, it's out of the money, which means it has no value. Okay, so it'll expire worthless if you let it go to expiration. Okay, so you have an unrealized loss of $200. So what does that mean, an unrealized loss? Well, if you bought it at 46, it's worth 44. You have a $200 drop in the value of your account, basically, because your stock is now worth $200 less than it was earlier. So, but you didn't sell the stock. Okay, so you still own the shares, but it is still an unrealized loss in the value, right? But you do get to keep the $100 premium. Once you sold that premium, it's yours to keep. Okay, and that offsets some of those losses. All right, and that's where you got to determine what you want to do because now your stock's in a downtrend. All right, so total loss in this trade now because you did pull a premium in, even though your stock went down, is $100 loss. Okay. All right. So some common pitfalls of covered calls. Some common pitfalls of covered calls. All right. Traders can become greedy when the stock is up near resistance. So we're going to show you the setup here in a little bit. All right. When it gets in there. So when your stock is up near resistance, you might have some higher levels of premium on the options chain. All right. And you may decide that, ooh, if I'm at a level of resist of if you go to your technical class, go back to technicals class. Remember, if my stock's up near resistance, let's say resistance is $50, and I sell the $50 strike, okay, I probably need a little bit more money for that. right? Because you're selling real close to the strike price, all right, or the stock price. And that may you're saying, yeah, look at all this premium I'm getting in, but now you get maybe get called out right away. That might be that might be what you want to do. All right. That's up to you as an individual trader, though. Okay. Traders may not realize the impact events can have on options considering earnings, dividends, market drops. So, when we talked about yesterday, remember volatility, and we talked about how you get closer to an earnings announcement, that volatility can spike up, okay? And you get some, and when you're, and by the way, we talked about this briefly yesterday. If you remember, what do seller of options like to see? If you're going to be short an option, do you want to sell more volatility or less volatility? Oh, you might want to sell more volatility, right? You like to see volatility high and falling. So you got to understand, be ready for that kind of stuff. What happens when dividends are paid out? What does the stock price do when dividends typically get paid out? It adjusts that level of dividend paid out. It can fall. All right. So understand the different things that can happen, different market conditions, news, those type of events can do on your stock price when you get in. All right. Traders may fail to understand that low volatility, all right, typically means the stocks are up near resistance. All right, anyway, and this can be tied back to this top bullet point. Okay. This may be an opportunity to consider selling covered calls. Okay. So you're going to remember high VIX and falling may be a good opportunity. Low VIX and rising may not be the best because you're going to not get as much money for that. So be aware, understand those type of activities. Now, what I want to do before we get to this next section, I want you to take a breath. Sit back in your chair, take a breath, because we just did a whole lot of what ifing, right? All the what ifing. And we kind of talked about what's happening. Okay. So what I want you to do is I'm going to show you a couple of things to get your mind focused back in. All right, take a breath here. Now, when it comes to the Thinkorswim platform, I know some of you may be new to Thinkorswim, and some of you may not be. Either way, this is an opportunity here where you can go in and you can actually set up a one-on-one consultation with one of our Thinkorswim reps that's out there. And they're experts on the platform of how to set things up on your platform, how to draw those lines in. And as you get through your technical analysis class, I see there's a question on what is considered resistance. There's a technical analysis class you can take. I'm going to show you where you can find some of this. All right. All those type activities. So take full advantage of this. Those who have done it already, if you want to write and put a positive comment in there, I know it's going to be positive because it always is because these guys are phenomenal, is take this class, go in there. But here's a hint for you. Before you get your call with the rep, put your questions down as to what you want to see and how they can help you with regard to how to get your platform set up or the things that you want to do. All right. That way you're not fumbling around, not knowing what to ask when you get the call going. Okay. Now,
Hey, Ray.
yeah,
Just real quick in regards to this, gang, we want you, every one of you, to set an appointment with one of those Thinkorswim reps. But if for whatever reason you're not able to keep that appointment, please make sure you go there and make that adjustment so that somebody else can
yeah,
take
good
your
point.
spot. Yeah, we often run into times where there's just a huge demand, and then sometimes those things happen. So please just be aware of that.
Yeah, great job. Great job. Thanks for reminding on that. It's a great job. So, by the way, Charles Schwab owns Thinkorswim. All right. So, um, right here, I'm showing you in front of me right now. Scott Thompson. All right. Great man. All right. He's been dropping in a link. All right. On getting started with options. All right. Getting started with options. So from yesterday's class, all right, all these kind of things. Here's all kinds of cool stuff going on here. Look at this. Ooh, short calls. Guess what a covered call is? A short call. All right, getting started with options. Cameron May right there. All right. So all kinds of cool things that you can get started with. There's a whole lot of them in there. And that's what it's going to look like when you hit that link. All right, there it is right there. Scott, just put it in. All right. And get that link and if you want to see and put and capture this and save it, by all means do so. Now, the other thing that you can do is if you go to your Charles Schwab, I'm logged out already. Let me see if I can get back in real quick. Hold on. We got plenty of time, folks. But this is important to you. Okay. All right. And then here you can see my password now.
Dot, dot, dot,
Yeah. Yeah.
dot,
Oh wait,
dot, dot.
actually I got it on. I do gotta close it. Or you would see it. Oh, okay. Thanks. I did put it on there. Dang, I'm an idiot. All right. Oh, I can't get in. Dadgummit. All right, never mind. You can go to this screen, show them this. All right, so folks, what you can do is if you go into your YouTube channel, this is why you want to subscribe. All right, hit that subscribe button. All right, so you can get all this stuff. So look up here. All right, this is the YouTube channel. All right, this is all of our stuff. When you get content and you subscribe to this, you get all these things. All right, tons of it. All right, now watch this. If I go up here on search, all right, let's do covered calls. All right, oh my. Guess what we've been teaching all morning so far, or afternoon? All right. Yeah, go Rangers. All right, is this. All right, look. Here's the workshop. All right. When you go through uncovered calls, here's look, lesson 5 of 12, buy right covered calls. Ben Watson. All right, you got Barb Armstrong, bullish strategy, buy right covered calls. All right, verticals. Here's oh, I'm going crazy here. Let me go next one. All right. If you go, I don't want to click on it. If I click on it, it's gonna open up the stream and start going. So, all right, ways to roll the short put, all right, into the next month. Covered calls, all right. So all you gotta do is put covered calls in there, folks. Look, 590 videos. Oh my gosh. All right. Make sure you take advantage of it, folks. All right. And you'll have a great time getting things in there. All right. Our great coaches are in there and they can help you out. All right. So there you go. Take full advantage of all that. That's where you can find it. A lot of extra classes you can do, and I highly encourage you getting involved in that. All right. Is your mind's back into the ready to go? Yes. Geez, 590 is right. Okay. All right. Here we go. Let's get back into it. Scott Durfey, how we doing, buddy?
We're good. We're tracking well. We're learning some important stuff. Review for some, new to others, but we're
All
tracking
right.
well. Right?
Here's
This
some live events coming up. If you can get out to these areas, Chicago, Illinois, July 17, 18, you'll see Scott and me in person along with Ben Watson, some other team members. And we're going to be doing this, technical analysis day one, options day two. You got a market drive coming up. This is a one-day event right here in the Gaylord, Texan, and Grapevine, Texas. It's going to be a huge, massive event. One day, a little bit larger picture, if you will. All right. And then you got Orlando, Florida, technical analysis and options. Yes, Orlando in August. We're indoors. All right. Don't want to hear anything about heat. Okay. So,
and at a very nice resort hotel. Both of those Gaylord hotels are just superiors. So
all right. I see someone said they don't need 1,500 videos, just one meaning. Well, they're all meaningful. So you can pick what you need. How about that? All right. We don't want to be limiting you. Okay. All right. Let's go. So now, this is why I showed you, and I wanted to, and Scott and I talked about this. This is why we wanted to show you a little bit more of the Greeks first thing, all right, when we started off, because this is very important. All right. Now, let me draw something real quick for you, okay? We'll talk about this expiration. All right. So, if you remember, a lot of you are asking, what strike do I need to pick? Okay. And how do I need to approach, and what do I need to get a trade? So, let's look at this. All right, expiration 50 to 20 to 50 days out. Okay. And the reason for that is what? Time decay. Because you remember what we say, what happens every single day with theta. Let's draw it in. Let's draw it in. All right. So here is your chart. And if you remember yesterday, we kind of drew this line like this. All right. And this is the fire. This is expiration, right? That's all that heat. All right. This is expiration. Okay. And then if you're going to buy shares, we told you to buy further out in time. Okay. Remember that drawing? 150. All right. 150, maybe 50 days out. Okay. Because when you're further out in time, theta's not eating you up alive. It's not doing much. Okay. But when it comes to covered calls, You don't want to be in there for a long time and having your stock tied up with the call. All right. You want to take advantage of theta. So if we get into your trades here, okay, like this with theta. So if it's 50 here, and 20 here, whoops, sorry. All right. Drawing with a mouse sometimes gets tricky. All right. So when you do this, what's happening if you can see the line, what's happening to theta when you're on this side of the spectrum? It's eating away that value more quickly, right? So that's why we say over here on expiration that you may want to look at in your options chain, you may want to look at placing the trade, selling the call, all right, 20 to 50 days out so that you're having that taking advantage of the decay because you want it to decay quickly. You want that option to lose its value. Ideally, you'd like to see it what? If you want to keep your shares, and that's the idea, you want it to be worthless at expiration. All right. And that way you don't have to do anything at all. Because if it's worthless at expiration, you can just let it disappear. It just goes away. And you don't pay anything. You keep the premium, the option's gone, your obligation's gone. You keep the shares, and you can do it again the next month if you like. Okay. So again, this is kind of a why I like that graph. It kind of gives you it dictates and shows you how you do it. So here you're going to sell the call up here. All right. You're going to sell your call here and then potentially buy it back down here. Now, Scott Durfey, why would I say buy back the call or close the trade before it gets to expiration? Why would I do that?
Well, because a lot of things can happen at or before expiration, right? And we've seen this. Traders and investors will often say, 10 days before expiration, I'll start really evaluating, is the rest of the juice worth the squeeze?
Mhm.
Right? I mean, because potentially, I could go in the money and lose the stock where I didn't necessarily have the stock called away. There, I used it again. Have the stock called away when I don't necessarily want it to be, for example,
There you
or
go.
or whatever. There's a lot of things that could
Yeah.
happen. So yeah,
And so a good question came across where I was saying is why not just sell the 10 days out? You can,
yeah.
but what is that other factors? Fun thing, you're obligated. You don't have a lot of time to manage the trade, and we'll get into exiting here in a minute. Manage the trade with less days left. And what else is in there? You got that gamma crush. So a little bit of move in the stock can make gamma dramatically change the value of your option with those less days as it gets closer to expiration. So be careful of that. But there's nothing that says you can't do that, okay? But that's why we did a little example of the Greeks. And again, there's a lot of Greek discussions. Same way you showed covered calls, you do the Greeks the same way. You can watch the videos on Greeks. All right. So there's theta. All right. Why we're buying out 20 to 50 or selling 20, 50 days out. And then our delta between 30 and 40. Because if you have a delta between 30 and 40, that is like 30 or 40% probability of being in the money at expiration, or a 70 to 60% of being out of the money at expiration. Makes sense? Okay. So in this case, we're looking at those deltas in that range right there to give you a higher probability of being out of the money at expiration. Now, Scott brought up a good point earlier. Sometimes you may want to be called out. All right. And if that's the case, can you maybe sell a 50 delta? Sure, you can. All right. Not a problem. Okay. Now, let's look at this. All right. Let's clear the drawings and let's move on to the next one. All right. Let me close out of that. All right. So sample exit considerations. If the option looks like it will expire in the money, remember we talked about this earlier. I said I would bring it up again. If the option looks like it will expire in the money, you'll likely have to sell the stock. All right. And Scott gave you a good warning. Hey, before you place this trade, ask yourself, am I okay with having to sell the stock? And if your answer is yes, then you're okay. All right. If you want to keep the stock, all right, prior to expiration, consider rolling the option to the next month if you can do so for a credit. All right. Otherwise, you're just chasing a bad trade. All right. If you can get a credit again, roll it out to the next month and just keep rolling it. You get more money in your account, but remember, you're still tied up when it does it. I'll show you how to roll here in just a minute. But here's the thing, folks. A lot of people get freaked out by the name rolling their share, rolling their trade, their option. All rolling means, all rolling means is you're closing the current short position, in this case, the call, by buying it back, and then you're selling a new call further out in time and or further out in time and different price. Okay? All right, that makes sense. All right, consider buying back the call altogether and just being done with it. Now, here's the thing. When the stock goes up, all right, and Scott taught you this yesterday, when a stock goes up, a call will do what? Go up. So if you sold a call and the stock price is going up and you want to get out of the trade and you just want to buy back the call, you can, but are you going to lose money on that? The answer is yes, because the call went up in value, because the stock went up in value. So just be ready for that if that comes to that case. All right, if the option looks like it will expire OTM, out of the money, considering letting expire worthless or closing the short position positively before expiration. And again, Scott talked to you this a minute ago. And why is that? Eliminates the obligation. Okay, you eliminate the obligation when you do that. No, if your stock exit rules are triggered, remember to buy back the call before selling the stock. I talked about earlier because you don't want to be naked. You don't want to sell the stock and have your call out there, a short call. All right, if you can, and have a naked call in your position. All right, so what does rolling mean? Roll out. Keep the same strike. You just went out in time. I'm going to show you an example of this. Bearish, roll down. All right, which means you sell out further in time. Or if you got plenty of time left, you might want to close out the current, sell the current time you went, but lower the strike price. You can do one or both. All right. Or if the stock is bullish, all right. So the bearish means the stock went down a little bit. If the stock's going up and you want to roll up, that means you're going to go out in time more. Or if you have plenty of time left in the current month, you can still close it out, sell the current month at a higher strike price. Okay. But just remember, if you do either of these three, you need to be what? Rolling it for a credit or forget it. Okay. Roll it for a credit or forget it. All right. Let's go live. Let's go live. All right. How we doing? All right, folks, we got 20 minutes to do some live trades. Now follow along. Okay. And we're going to see how it rolls here. All right. So what I'm going to do is I'm going to go to my monitor tab and show you, all right, that oh, we got a working order in that's pretty good. That's that one we just did. All right, so I got some stocks here that I've already bought. Okay. I'm in my monitor tab. Now, my monitor tab is split up. So I got a few vertical trades going on here, just for examples. I got down here, I got a couple covered calls I did a couple of days ago. You can see we're doing pretty positive on that. And then I got some single trades going on, some different types of options going on right there. And this is the trade we just made earlier. Didn't get filled yet because the market's closed. We'll see how that rolls maybe tomorrow or on Friday. All right, so here we go. How do we do this? How do we buy a covered call? Let's say we go out and we don't own the shares yet. Okay, we don't own the shares yet. All right, and we're peeking at your list. I like that. All right. And we want to buy a stock and do a covered call on it. We don't own the shares, so we're going to buy a stock and do a covered call on it. And let's do which one do we want to do? Let's see. Let's do UNH. UNH. Okay. I don't think I own UNH in here. Here's UNH. Now, UNH, is this a positive looking stock? What do you guys think? What do you think, Scott Durfey? Is that a
I'm
bullish? Bearish?
I'm going to use the word bullish. Yeah, positive. I'm not so sure. That's dependent on your
Yeah.
outlook, but it's definitely has it. So it's let's just review it. Really, it's a medium term or midterm uptrend, a short term uptrend. It looks like we are potentially at a level of resistance, and there is an event coming up, which is a dividend, which will adjust the stock price as
Yep.
well. So there you
All right.
have it.
So, and I got real quick, I got a lot of comments when I showed that monitor. Folks, this is a training account. This is not my account. All right. And so don't freak out. Okay. All right. So here we go. So, So because of this, all right, and this is one of the criteria we talk about. We want to be, and because this is a bullish trade, covered calls are a bullish bias. All right. So you want to have, if you're going to do this, I would like to own stocks that are bullish. If I'm looking at stocks that are in a downtrend, okay, is that going to do me any good? Because it's not helping my account out because the stock's going the wrong way. So I like looking at more bullish probabilities. Now, here's the MACD, it's rolling up. Our RSI is rolling up. All right. Our stock's in an uptrend. All right. It's not exploding heavily. Okay. But it is in an uptrend. Okay. So in this case, maybe this is one that we want to buy the shares and do a cover call all at the same time. So how do you do that? Well, if we go to trade, all right, we go to trade. All right. I'm going to close down this 9 days out. I'm going to look and then remember our slide. What did our slide say? How many days out to expiration do we want to look? 20 to 50, correct? We wanted to look 20 to 50 days out. Okay. And the question, do I consider the earnings date? Yeah, I can consider earnings date in this because can earnings really move the price negatively against you or positively against you, so to speak? Yeah, it can. So that is something to be aware of. So thank you for bringing that up. All right. So in this case, though, we're just doing examples. So I want to show you how this works. So here we opened up the 38 days to expiration. All right. I have it set on 8 different strike prices. Okay. And in this case, we can see different strikes that we want to look at. Do we want to look on this side or this side? We want to look on the call side, right? Not worry about puts right now. Okay. So over here is the delta column. Now, what was the delta that we had on the strike? We said if you want to look at deltas to have the the odds in our favor, so to speak. All right, we want to look at what? We want to look at the delta between 30 and 40, right? Okay, 30 and 40. All right. And that's because we want to have a between a 60 to 70% probability of being out of the money. Because remember, delta is the probability of being in the money at expiration. Okay. And then I have a question here. Why 20 to 50 and not use full weeks like 21.49? It's just a round number. Okay. 20 to 50. Okay. It's just a round number. You don't have to get too wrapped up on it. Okay. Very good. 30 to 40. So in this case, here's a delta of 36. Scott Durfey, how's that sound? 36 delta. All right. Which makes it a 43 $430 strike. What do you think?
Yeah, you know what? Go to your chart real quick and let's just see where that falls.
All right. So right now, before we get there, it last traded at 413, and I'm saying I want to stay below 430. Y'all
430.
follow me?
Right. Yep.
I'm going to sell the 430 call. It's trading at 413 now. I'm going to say, okay, I'm going to buy this, and I'm going to sell the call to say I think it's going to stay below 430. All
That's a
right.
$17 move.
Yep, $17 move. Here we go. All right, and so here's 414, 430. We're currently traded, and 430 is right up here. Let's draw a line. All right, where's my line tool? Trend line. All right, if I want to go 430, it's about right there. Okay. Now I'm going to ask myself, am I okay of losing these shares if I buy them at 430? And I'm saying yes, I'm okay with that. All right, because what could happen? I could lose them. I get called out. I can get assigned. Okay. Now then, let's go back to the trade tab. All right, trade tab, go up here. All right, now, this is a $430 stock. It can move pretty rapidly, right? It can move, in this case, they're saying it can move $38 up or down within the month. Okay. That's what it's saying. That's what that number over there means. Okay. But I'm okay with that. Matter of fact, Scott talked about it earlier. You could be okay with losing, having to give the shares up at 430. All right. So here we go. If I'm going to do this, I'm going to right click, all right, on 430. All right. And then I'm going to go to buy because I'm buying the shares. Okay. And then I'm going to buy a covered stock. I'm buying a covered stock. Okay. Now, someone said it's a too low of a delta. No. Remember, I want a lower delta because I want a higher probability of being out of the money at expiration. Okay. So I'm going to buy a covered stock, and this is going to come in and going to say, okay, I'm going to sell the 430 call. Okay. And I'm buying 100 shares. Now, look, this says it's going to cost me 401.90. Well, wait a minute. 401.90. But wait, the stock's at 413. but I'm only spending 401.90. And now why is that? Because I'm pulling premium in. Remember, I'm selling a call. I'm pulling in the premium. Okay. So that's going to set up the trade. Now, one of the things you may want is to set up a closing trade at the same time. So if it goes against you, it can sell at the same time. Set up a sell order. So for example, so Scott, if I was want to get in this trade and I go, okay, if I go back to the charts tab and this stock starts coming back down to this level of, let's say, support right here, okay, and this support's at 473.98, all right, 473.98, and I say, you know what, if this starts falling back down here, I want you to get me out of the trade. I don't want to be in the trade anymore, okay? So if that's the case, how can I do that with this trade? Well, if I go to the trade tab, now I haven't placed this order yet. What I can do then is I can say, now, remember, if you want to get out of a covered call, what do you have to do first? You got to buy back what? You got to buy back the call, then sell the stock. So how can you tell the platform to do this? Well, if you go down here to advanced order where it says single order, if you open that up and do first triggers sequence, and then I'm going to go on this order right here, right click, and I'm going to create an opposite order. All right. Now look, it's going to sell. So I got one that's going to buy and one that's going to sell. But right now it's going to sell at 430. I don't want to do that. I'm going to go here and I'm going to click on market order. And you're going, oh my gosh, you don't want to sell market orders. Well, in this case, I want to sell a market order because I'm going to change something. I'm going to go into its guts and say, hey, I'm going to tell you when I want to sell it. And whatever the market price is at the time, do it. Okay. So if I go over here to the gear on that sell order and click on it, whoops, sorry, it went to another page. Hang on, I'll get it over for you. Okay, there we go. I'm going to sell, okay, and I'm gonna go in here. I'm going to click on the symbol, okay, because it's gonna put UNH in there, okay, and I'm going to sell the mark, and I'm going to sell the trigger when the price gets equal to or below. And we said, what was it? 378, Scott?
378, I
All
believe.
right.
Yeah.
I'm going to type in 378. Okay. And when I do that, I'm going to hit save. Okay. So now when I hit confirm and send, watch what it does. It's going to say, okay, I'm going to buy the covered call. All right. 430 UNH. Okay. 401. I'm going to get the call $401 to do this. Got to buy the shares to sell. And then based on the coverage, I'm going to can do a covered, I'm going to sell that covered call. All right. When it's triggered by number one, when it gets down to that 378. Okay. Now, don't know the break even price because I don't know what's going to happen up here on this. Okay. And I can see my mark is at or below 378. That's my condition order number two. All right. So we read through it. We're good to go on that. So if we like that order, you know it's going to cost us $40,000 because we're going to buy the shares. Okay. And I have my stop in place automatically. Cool. Boom. Off it goes. Let's do another. Okay. Let's do another. All right. I know that might have been a little bit confusing quick, but let's do another one real fast for you. What do you think, Scott? You did another one?
Yeah.
All right.
Um, do you want to are you doing another buy ride or do you want to leg into one?
I'll do my Bobby, then we'll leg into one.
Okay.
All right, let's do CMC. All right, CMC. All right, kind of going sideways, yes.
Yep.
Short-term trend upturn, intermediate up, long term is over year is sideways. MACD starting to roll back up, RSI is rolling back up. We got earnings coming up, but I'm okay with that. Let's look at how we're going to trade this one. We go to trade tab. All right. We look at the same 38 days out to expiration. And let's say on this one, we want to go even tighter. We're saying, you know what? Let's go to this 47 delta. And let's, on purpose, like you were saying, Scott, let's say we want to get out of this trade if it goes right away, if it goes up and takes us out. I'm okay with that. So right click, buy, covered stock. Okay. We'll do the same thing again. Here we go. We're going to sell and we're going to buy 100. All right. And it gives us our amount right here. If we want to put our stop order again, okay, if we want to do our stop order again, All right, when we go back, it's the cost of 72.29 because remember you get a credit and you got to buy the shares. They're at 75, so we already got our discount.
Ray, I think it's important that you take just a second on that. You'll notice that you're not receiving a credit on this one, but the credit is being measured against the debit on the stock. So
Correct. All
results the
right.
same. Yeah.
First trigger sequence. Okay. Right click, create the opposite order, change that to a market order, go over to our gear. Ah, why do they keep doing that? Hang on, folks. I'll get it to you. There we go. Different screen. All right. I'm going to go click on this symbol. The method is the mark level, less than or equal to. And then what do we want to go down? If it goes, let's say to $70. If it falls against the $70, okay? Just picking one for you. All right. All right. Then I'm hit save. Okay. And then if I hit confirm and send, I got my conditional order. I'm going to do the covered call, 77.50 call. All right. Limit to open. I'm going to sell if it goes against me. All right. It's going to, but it has to, the other order has to fill first. And then if it goes down against me, all right, below 70, it's going to get me out of the trade. So you set your exit up while you're buying it. Okay. And now why is the sell at 1 and buying 100? Because I have it defaulted to buy 100 shares and sell one contract. And you can set your platform up to do that. Okay. And to do that, you just go up here to your setup on top of your platform, and you go to application settings, and when you go to order defaults for options, and you can set it right there. And if you go for stock, you set it right there. Okay. Hit apply settings and you're good to go. All right. So Scott, you said we want to do a leg in, right?
Yeah.
All right. So let's go to the monitor tab. And then we go to the monitor tab. Remember, this is a fictitious account. This is not my account. Okay. So go to the monitor tab. We're going to go in and let's look at ADM. I think I have like 500 shares of that or something like that. Yeah. Right here. All right. I have ADM. I have 500 shares of this one. Okay. I bought it at 60. It's currently at 80. So it's doing pretty good. Yes. All right. Not too bad for this is profit loss for the open. All right. And so if I want to do a covered call on this, all right, can I do it from right here? The answer is no. You got to go to the trade tab. But here's the thing. If you have trades like this, you have an account and you have stock in your account, you have to do the covered call in the same account that you have the stock in. So you can't do a covered call by selling a call in a cash account and have your stock in an IRA. They have to be in the same account. Okay. They have to be in the same account. All right. Now, here we go. Let's go to the trade tab. All right. And now we're going to go to ADM. All right. And hit enter. And there's ADM. Now, if I want to place a covered call on this, okay, I'm going to go here. And what am I going to do? Am I going to just hit sell here? If I go to this in the money, I don't want to do that. I want to go out. I want to go to, remember, 32 to 40 delta because I want a higher probability of being out of the money at expiration. So let's check this 32 delta, 30 days out, 38 days out. That is a 85 strike. All right. So if I go here to 85 strike, can I just click on the bid price? Because that's selling the option, right? I know I have the stock. The platform and the broker knows I have the stock. So if I do get called out, they know to grab that stock. All right. And they know to grab, in this case, one contract. All right. And I'll sell how many of them? I'm going to do one contract. I'm going to pull in $1.55. Okay. Or $155 on stock I already own. Just pull an extra 155 in. All right. Could I do more than one? I have 500 shares. Could I do more than one? Yeah. I could
Do
do up
them
to
all.
5 if I want. Yeah. Do them all?
Do them all.
All right, I'll do them all. All right. So now, if you do plus minus, you got to do the minus because remember, you want this negative because you're selling. Okay. So now, when I hit confirm and send, I'm going to pull in $775. Okay. And all it's got to do is stay below 85 bucks. Okay. Stay below $85. So if I go to my charts tab, I can't yet. Let me delete this real quick. and we'll redo it again. If I go to my charts tab, 85, all right, is its all-time high right now. All right, it has a little pullback going on right now. It's kind of been going sideways. All right, so that now I know where I'm at. All right, so let's go back to the trade tab. All right, I'm going to sell. All right, I'm going to do 5 contracts. Okay, confirm and send. There we go. And now in this case, it says max loss infinite. Well, the reason why it says infinite, it doesn't, the order doesn't know I have stock in my account, but we know. Okay. If you had, if it was a buy or a covered stock trade like we did earlier, it shows you your max loss amount. Okay. All right. Here we go. Send. Now that's off, ready to roll. Now, let me show you something real quick, and then we're going to be done. When you have trades that are pending down here, they'll be down here pending, and we'll see how they roll tomorrow. But there's one right here. Here's one I did earlier. I own this stock, all right, in this fictitious account. Where's it at? Oh, IREN. See, I have 500 shares right there. I bought it at 650. It's now at $54, right? So I have a covered call on this, and I know this because here it is IRN. How do I know? Well, if I open this up, look, it says -1. The reason I know that's a covered call, because calls, it's a -1 in front of it. Okay. I know it's a call trade. So I know I have this out there pending. Okay. Now, if I want to see this as a covered call, all right, I can make different categories up here. You can see up here, one covered call, I made it. How did I do this? Let me show you real quick. So if I go in here and I go all the way to the right of IRN and I go to the little menu stack on the right-hand side, I can go up here and I can also trade in and out from a monitor tab, but I can go in and I can move to a group, okay? And I can make groups and all that kind of neat stuff right here. So if I want to move this to a group, I made a group, all right, called covered call. So I can click that, move it to the covered call group that I made up here. So now in my little drop down, I can track the calls that I sold short in a leg in its own category, so they're not mixed up with other call single options in my account. So how did I do this? So if you go up here to your this position statement line bar right here, go to the far right menu stack. You got to be into the new layout. You got to be on new layout. You got to click show groups. Okay. Then you come down here by group symbols by spreads. Group symbols by spreads. And when you do that, you select which ones you want to come out, the ones you do most often. And when you select these, what it'll do is it'll create those different categories. You hit OK, and that's how those categories got brought into my account right there. Whew! How about that for covered calls, folks? I hope that made some sense. Scott Durfey, what say you?
Great jumping off point as we start to make a little income potentially using options. Be fun tomorrow too. We'll kind of expand it tomorrow. We'll kind of talk about short puts, selling puts for various same reasons.
Yeah. Well, Scott and I hope you enjoyed the class, and you got some great feedback for us yesterday. And here's the survey for today's class only. Okay. So please take a minute, fill out the survey for us. I know Scott's been dropping that in also, but take a minute, do that for us. We greatly appreciate it. Give us your feedback. And remember to subscribe. All right. Hey, we had a goal yesterday to get over a certain amount, and you all did great. Let's really explode our account up, and let's get another couple thousand people subscribed to Trader Talks, and I think it'll do you well. But there's your survey for us. I want to thank you immensely for spending your night with us. I'll bring it back to you in a minute. Got to show these real quick. All right. But Scott Durfee, tomorrow is what?
Tomorrow we're talking about cash secured puts, another great potential income type
Yep.
of strategy.
And we'll do the same kind of thing. We're going to do slideshows, and then we're going to do examples and walk you through it. Hope you step by step and it makes sense to you. But you guys have been awesome. You had some great questions in there. Again, you can still add questions for us for our Q&A session. Scott's been putting those in as well. We'll discuss it again tomorrow also. But we're out of time. And I want to thank Scott Durfee for all your great help, my friend. And I want to thank all of you all. And I want to thank Scott Thompson as well. And see you tomorrow. Scott Durfee, how do we end it?
Same bat time, same bat channel tomorrow. We'll see you all then. Take care, everybody.
See you guys.